Just take us to our talk of the tape. With another month about to be in the books, what does lie ahead for your money over the remainder of this year? Let's ask Cameron Dawson, Chief Investment Officer for New Edge Wealth, with me here at Post 9 once again. It's good to see you.
Good to see you.
How does the backdrop feel to you in this market?
It's not too surprising to see this volatility. We had been seeing this somewhat dangerous divergence start to brew over the last month, where yields moved a lot higher. Earnings estimates were getting cut for the fourth quarter and for 2025. All the while, the market kept pressing to new highs, and it was based just on valuation. So now that you're calling more questions about earnings with what Microsoft and what Meta said in that outlook into 25, not surprising to see some of this volatility kind of catch up to us.
Yeah. Speaking of, do these mega cap reports, is the lesson today that they need to be really perfect?
I think so. I think given the fact that positioning is so crowded, we can talk about valuations. Not all of them are very expensive, but we do know that a lot is riding on these earnings, because if you look at the source of earnings growth in the third quarter, mega cap was delivering all of the earnings growth. The Mag 7, 18% growth. The rest of the 493, 0.1%, which just means that they have to keep delivering. If you look at the street estimates, that kind of high teens growth is what's expected next quarter and through the remainder of 2025.
What do you think on this final trading day of October has been the story of this month? Is it the backup in yields? Is that what the biggest takeaway is going to be, and what we need to watch closer than anything else?
I think that it is the backup in yields, because it's telling you that the increase in yields is not because of something necessarily that the Fed is doing today, but because the economy is holding up better than expected. It is raising the questions of potentially higher inflation into 2025. We don't see evidence of that yet. Look at the ECI, the Employment Cost Index today. We're not seeing a reacceleration in wage growth. But I think people are starting to call into question, are we going to get the cuts from the Fed if this economy isn't falling off a cliff?
Well, I mean, what if we're not going to get as many as we thought? How much does that matter? We got 2 more meetings before we turn the calendar into 25. What if we don't get 2? Does that matter?
It hasn't mattered all this year. We started this year with 6.5 cuts priced in, and we got all the way up to just 1 cut priced in, and the market still continued to rally. I think the kicker for the market when it comes to the Fed is the perception that if Fed rates are going to weigh on growth. That's what happened in 2022. The Fed said we're increasing interest rates. People started cutting their growth forecasts, and that's how we had a bear market. So if this market is still in an environment that says we can tolerate higher rates, it means that the Fed may not cut as much. Certain pockets of the market might struggle, like small caps, but overall, as long as the earnings story is intact, it can tolerate these higher rates.
There's been some commentary over the last few weeks that with valuations where they are, you should expect muted returns in the years ahead. You don't sound that optimistic from the notes that I've seen that you gave to our producers. For 2025, right? Your base case is for lower returns. Now, are you talking about much lower? Because we've had an amazing couple of years here. So do we need 20% return to be happy? I don't know, but what are you really talking about?
We're talking about something that looks much closer to average at best, something that looks like sideways and choppy. And the reason I'd say at best is because if we take current consensus for EPS growth of about 13% and say we don't know if we can really push valuations near 22 times that much higher, which just means that at best, you get what you have with earnings growth. And at worst, you actually get multiple compression. And so it's a question of, as we move through the year, where does that valuation multiple go? And we have to simply appreciate at today's levels, there's probably a lot less upside than we had starting 23 and 24.
But if I tell you, okay, economy's good, we know that, earnings are good, they are. Fed's cutting. So what if they're not cutting as many times or as large as we thought? And then you've got all this pent-up demand for M&A. Aren't all of those, and not just, slight positives for the market, but big positives for the market?
And add on top of it the fact that we still have stimulative fiscal spending into a strong economy with the backdrop of easier monetary policy. all of those things would be very good, are typically good. Which
Why
means,
not this time?
Well, because I think it does raise the risk of a potential melt up where valuations get so high because you're throwing so much stimulus at the economy that effectively you pull forward returns. So we saw years like 2018. There was a great backdrop in 2018 of tax cuts that led to strong earnings growth, and it ended up being a flattish year, only because we started at such high valuations and the Fed was pulling back on liquidity a bit, simply because of the growth that you were seeing from the earnings side.
What are we supposed to think about, the election? The market was obviously, pricing certain trades in. I don't know if that was getting ahead of itself or not, and we're not going to know till next week. And hopefully we know next week. But how am I supposed to, as an investor, think about the potential risk that lies ahead with the election looming, not to mention the Fed meeting next week on top of that?
We've seen the biggest moves within the bond market as well as in cryptocurrency markets, where there's been the tightest correlation between Trump's odds of winning as well as the Republican sweep and the price action in those areas. It raises the question of the lesson from 2016, which was effectively a sell the rumor, buy the news after the election. So you saw a big jump in yields in 2016 for the 2 months following the election, and then they kind of drifted down. So maybe we're seeing some of that pull forward today. We do have to consider the wild cards of the election results into 2025, where we could have things like higher corporate taxes on one side, and then on the other side, potential supply chain disruptions from things like immigration as well as tariffs and trade. So both of these things could potentially be market jarring, even if the underlying economy is still holding up.
So we talked a lot about mega cap, and we're going to obviously have Apple and Amazon after the bell tonight. There's been a good debate, too, about other areas of the market to be in that forget small cap, because there's just there's too much noise around small caps. If yields remain elevated, maybe that trade doesn't work. But midcaps getting a lot of love. What do you think about that part of the market?
Certainly. We've been preferring mid caps over small caps because they typically have better balance sheets. They're not as sensitive to interest rates. And what we are seeing is that you have a lower base for earnings growth going into 2025 that allows you to jump over that. We think you have to be highly selective, though. We use the phrase quality because it really allows us to find those names that are much more stable through cycles, have reasonable valuation. So it's not just buy all mid caps, it's buy selective mid caps.
How much do tonight's earnings matter then for the near term? We are talking about the most valuable company in the market. I mean, it was teetering with, flipping back and forth with NVIDIA, but Apple still has great importance to this market. Does it still have as much as it used to? We used to talk about it's like as Apple goes, so goes the stock market. Now, I don't think we need to do that anymore, but you tell me.
Maybe the read-through is the connection of Apple's valuation and the overall market's valuation and how much this market is willing to pay up for growth. Apple's trading at about 30.5 times forward earnings, which is near its 2021 peak. That would say to us that that's a pretty high bar that they have to deliver. Apple's earnings have never been that extraordinary in the last 2 years. I think the earnings growth is close to about 9% this year. So it really comes down to the valuation. And if the results are not received well, maybe there's a read-through to how well this market will tolerate today's broader high valuations.
All right, so you stay with me because now we're going to talk more about Amazon. It is obviously one of the big reports that we are watching for in overtime. Kate Rooney is watching that and will tell us what we need to focus on most of all. Kate?
Hey, Scott. So the setup is important to talk about here as well for Amazon. Expectations have really come down since the last quarter. The list of worries around the stock has weighed on sentiment lately. Amazon has underperformed most of the Mag 7, at least in the past 6 months or so. In the second quarter, the last report, Amazon did see some margin compression in that North American retail business. It's something people are watching closely. They also warned about consumer spending pressure. The ad business also didn't quite wow Wall Street the way some had expected. Amazon, though, did have Prime Day in the last quarter, which could lift sales today. We'll see. And then there's really high hopes for Amazon Web Services, AWS, especially after Google Cloud's strong quarter. AI is going to be a big part of that story. AWS growth is going to be the key number to watch and to beat. Street is expecting that high-margin cloud business to deliver 19% revenue growth for the quarter. It's a big number to beat. Analysts are going to be watching for any sort of commentary on retail for this quarter, the consumer, and then CapEx. That commentary is also going to be key. AI is really a balance here. and then guidance after Microsoft disappointed on the guide. Bank of America, I think, really summed it up well. They said it's a balance of AWS optimism versus retail margin uncertainty, Scott.
Yeah, it looks like, Kate, that AWS growth, after flattening out for a few quarters, looks like it's reaccelerating, albeit slightly. That's key.
Yes, absolutely, Scott. So they did sort of flatten out, I guess, last year, you could say. And that's been the big part of the bull case, is that the margin expansion, the growth on AWS. It's the high margin, really profit engine of this business. That's why it's a big tech company. We think of it as retail, too. But one balancing act that they're going to have to do is show that the core business, the retail side, is also doing well in order to spend big, go after some of those moonshot projects. So really, I would say the takeaway is balance. They're going to have to nail it on margins in North America, show that business is doing well. And they did also see margin expansion on the retail side of the business after COVID. Margins were negative, and they've really turned that around. So it's a huge part of the bull case, but you've really got two sides of the story: retail and tech with AWS. But again, that 19% growth number is really what folks are looking for on AWS. So I would say that is the number one thing to watch today.
Okay. Good setup. We'll see a lot of you this evening. We look forward to this report. Kate Rooney, thank you very much for that. Let's bring in our panel now. Malcolm Ethridge of Capital Area Planning Group and Bryn Talkington of Requisite Capital Management, both CNBC contributors. Malcolm, you're the one who owns Amazon here. So what are you thinking about ahead of this report?
Yeah, so interestingly, Amazon is the one of the Mag 7 names that I am the most convicted about right now. And you heard Kate make the point that for the last few months, it has been the least loved of the Mag 7 names. But I think of all of the companies set to benefit from AI making its way into digital advertising, it's either Meta or Amazon as 1 and 2, and they're close first and second. And so I think that investors are really missing the opportunity that exists within Amazon in that digital advertising space. Partly because of the margins that they can extrapolate from what I've seen, 90 to 95% margins on ads being created using AI instead of human actors and models.
Are you thinking about what the spend is? CapEx numbers are just enormous for all these companies, Malcolm.
Yeah, I hear that point. I heard what Cameron was saying before about investors deciding that now is the time to focus on valuations and multiples. I know it's a little bit unlikely to me for me to be the skeptic, but I find it a little bit strange that now is when investors are deciding that they don't want to own shares of Meta and Microsoft specifically. They're selling those names off because of not liking what they hear in the earnings reports, when we knew last month and last week that these companies were redoubling their efforts CapEx-wise, building AI into all of the products that they're rolling out. And so I just think it's a little bit more likely that investors are deciding to take some profits during earnings when they knew that those numbers were going to at least meet expectations. And then, to borrow again a phrase from Liz Young that I love to use, come November 6th, we might see those same traders putting the money back where it came from.
Yeah. Bryn, what do you make of the price action today in the Microsofts and the Metas? Do that for me before I ask you about Apple tonight, which you own.
I think if I broaden out to the year, Meta's up 60% for the year, so down 5 is, to me, not that big of a deal. I think in terms of Meta is going to be able to monetize. They're doing so much on AI. Their report was really strong. Yes, their CapEx is up, 87% year over year. They're on par with Google. But if you go on Instagram, it's impossible not to buy something. And so I think they're going to continue to benefit from that. I think Microsoft, as a juxtaposition, is only up 9%. My energy names are doing better than Microsoft. I listened to the earnings call actually twice. Their revenues, they beat by $1 billion. They crushed earnings. Copilot, which I was concerned about, they announced Vodafone, UBS, big enterprise companies. And so I think that ultimately Amy Hood, who the CFO, she is conservative in her guidance very consistently. And I think she was conservative again. But I think you're going to continue to see a dispersion of returns within these 5 or 6 names that we talk about. Because year to date, this has been all about Meta and NVIDIA, not about the Microsoft, Googles, Apples, or Amazons, which really have been market underperformers this year. But I still do not think this is the beginning of the end. I think these companies will continue to monetize, and data center plays, to me, are still a great spot to be.
Bryn makes a good point, Cam. It's no longer the monolith, right? These are going to be differentiated and separated by virtue of how fast they're growing their revenues. For the cloud players, who's differentiating themselves, growing their cloud businesses the fast. You think about AI for consumer versus AI for business, and then you place your bets accordingly.
Mm-hmm. And if you look at the breakdown of the earnings of the different pockets of Mag 7, what you have is NVIDIA and Amazon have huge decelerations in their earnings growth. It's a question of how the market will be able to digest that. Amazon goes from over 100% this year to just 1% next year. NVIDIA goes 140 to just 40% next year. If you look at the likes of Google and Microsoft and Apple, they have much more stable earnings growth kind of year over year. And Tesla is actually the big swing factor of the last Mag 7, where they have a big acceleration baked in. So it's going to be very interesting how the market deals with this second derivative deceleration. And is that something that will weigh on growth, even though the absolute growth rates are still likely to be better than the market?
Speaking of growth rates, I guess, Malcolm, we're going to be paying super close attention to Apple's revenue growth, which was anemic, to say the best, for a while. Now we need it to, reaccelerate in a meaningful way. There was a time where we'd say, oh, my gosh, this Apple's reporting tonight. It's like the biggest event of the entire week. I don't know. It just doesn't feel that way. It feels like we're expecting kind of ho-hum, not only for the numbers, but the guide.
I think we're on our way back there, though, Scott. I think this is probably the quarter that just ended, I think, is the last mulligan that Apple's going to get on that growth rate, especially as it pertains to the iPhone. I think that the expectations around Apple Intelligence and the importance of Apple Intelligence for the upgrade cycle have been played up so big that if Apple is not able to prove during this holiday shopping cycle that there is actually demand for the iPhone 16 and that those sales reaccelerate, I think they're going to get punished for it in a major way. I also think that it's really important for all of the other consumer-focused AI companies out there that Apple actually show and deliver in this quarter that we're in right now, because we haven't really seen anybody test the theory that there is demand for AI among consumers. We've seen that there's demand among enterprise from Microsoft and Google Cloud and others, but Apple is the one who we can rely on to actually prove that there's legitimate demand from consumers and be able to monetize that in a meaningful way. And that's going to be important for all the other consumer-faced tech companies that are building AI products right now.
Bryn, you own it too. How are you viewing it? Because I don't judge from your notes either that you're all that optimistic about the near-term direction for the stock.
I think, Malcolm, first of all, just hit the nail on the head about this. This is going to be, over the next couple of quarters, I think really important, because outside of COVID, Apple's revenue growth was anemic on both sides of that. And so I think we want to see, not will people upgrade, but how long will it take to upgrade? The options market, which have been incredibly accurate, shows, Amazon plus or minus 12% post the report. Apple's only at 3%. And so at the end of the day, this plus minus 3 isn't that big of a deal. I'm more interested because there's so many analysts, like there's this amazing Chinese analyst in China that's saying that they're going to be terrible. And so I think that's going to flesh out a lot of this opinions that we don't know about. At the end of the day, their services are going to grow. Everyone has an iPhone. It's just how quickly are we going to upgrade? And I think that Apple will remain a market performer as it has this year. It's going to do what the market does. I do not think it'll be an outperformer in the rest of this year or actually the first half of 2025.
Let's not, Cam, either forget about what happens in China, too, where there was a lot of optimism. Now I feel like that's faded a little bit. You're talking about 17% of overall revenues coming from Greater China. So how do you think about that?
It's a big, huge question mark, because we've certainly seen other consumer-facing companies in China continue to struggle. Maybe there's a little bit of a light at the end of the tunnel. We had slightly better China PMIs today, but certainly in the grand scheme of things, it looks like that Chinese market is continuing to struggle because a lot of the stimulus is not directed at consumers, and that's what Apple cares about most.
All right, we'll see what happens. It's going to be exciting, as it always is. Again, Apple and Amazon coming up in overtime within the next hour or so. Thanks, everybody. Bryn, we'll talk to you soon. Malcolm, you as well, and Cameron, of course. We'll see you back here at Post 9.